Over the past few years, literally everything has gotten expensive, from flight tickets to used cars, clothing, and even fresh fruit and nuts. Policymakers in the U.S. have repeatedly described this steady hike in prices as transitory. But in recent times, the word has begun losing its place. According to statistics, inflation is running at an all-time high. While the Biden administration has continued to say that price increases are temporary, many inside the White House now believe that high inflation could become commonplace and last years. That, if you ask me, is not, well, transitory, unless the word now has a different meaning. Transitory inflation is best described as a temporary or short-lived increase in the rate at which consumer prices are rising in an economy. It is an inflation that is not thought to last, and where the inflation rate is expected to drop back afterwards. This type of inflation could be caused by supply bottlenecks in an economy where short-term supply shortages drive up prices. But then prices ease back down once extra supply comes on stream. In theory, transitory inflation should have little impact on inflation expectations of households and businesses, and a central bank might decide to keep monetary policy interest rates on hold if they perceive an acceleration in inflation to be transitory. But, from the look of things, prices will continue to climb, and finally, U.S. officials are beginning to admit it. In an interview, Fed Chairman Jerome Powell and Treasury Secretary Janet Yellen announced that it's time to retire the term transitory when discussing the current U.S. inflation trends, saying that inflation can no longer be categorized as short-term. We tend to use transitory to mean that it won't leave a permanent mark in the form of higher inflation, Jerome Powell noted during a congressional hearing. I think it's probably a good time to retire that word and try to explain more clearly what we mean. He added that while it's difficult to predict how long the effects of supply chain issues will linger, it appears that factors pushing inflation upward will linger well into years from now. I am ready to retire the word transitory, Janet Yellen, on the other hand, echoed in another interview well after Powell's that she was also ready to retire the word transitory, saying that it is now clear that it hasn't been a correct description of the situation. For example, the cost of goods and services from the beginning of the previous year has jumped by over 5% of the past year, with food prices up by over 4% over the last year and energy shooting up a whopping 30%. According to the latest U.S. Bureau of Labor Statistics report. That means overall inflation is running well above the Fed's goal, and that has been the case for a while. Also, since May 2020, the Consumer Price Index has been increasing consistently. All of this is to say that inflation is no longer a short-lived trend, an established fact after years of insisting and trusting that rising inflation would start to ease off. It is also important to consider that much of the current rise in costs is due to supply chain challenges and the rapid increases in demand that will likely ease as the U.S. continues to recover from the effects of the COVID-19 pandemic. The energy sector has also received its fair share, as there have also been increases in energy and food prices due to transportation and supply chain issues. There is no doubt that inflation is a big subject, a major one, not just within the financial media, but also in the marketplace. If you make a trip to the mart or the gas station, you'll be clearly aware of rising inflation in the financial market as it has become very visible. The financial market has experienced this inflation for a long time now. The question is, just how long will it last? In 2021, Jerome Powell, the chairman of the Federal Reserve, announced that the inflation experienced then was transitory, only to refute his claim later after the inflation refused to come down but continued to rise. Yet a fierce debate over its transitory nature has endured. Even though everyone has a vested interest, the more celebrated case and the one that has been awarded the most reasonability is the case for non-transitory inflation. Together, let's examine the accepted argument and its implications. While the case for transitory inflation may appear to be strong, it is not as good as the long-term inflation-labeled argument. This has shown that the idea of inflation plaguing us into the future is quite foreseeable. One notable point is monetary expansion. According to studies, the activities that have been carried out over the years would inevitably lead to inflation. Years ago, the renowned economist Milton Friedman claimed that inflation is strictly a monetary phenomenon. Essentially, the more money you print, the more inflation you get. Therefore, inflation is not transitory. Certainly, we've been printing more money. And the Fed will unlikely shrink the money supply in the near future, supporting the idea that inflation will be with us for a while, a long while. Another interesting point is wage growth, a stimulus for second-order effects that further increases inflation. Taking the labor market as an example. When workers collect enhanced unemployment benefits, the government creates a disincentive to working at jobs. Before you argue, in actual fact, there is plenty of evidence of this in the employment data, and based on the amount of calls for workers posted by restaurants and retail establishments regularly, it is impossible to dismiss the claim. Also, business owners have complained about a shortage of labor in recent times, claiming it to be a huge problem. So, in order to find and retain employees, business owners resolve to offer bonuses and higher pay. Sadie, once employees' wages are increased, it becomes difficult for employers to lower wages when things get back to normal. Invariably, these increased costs are eventually passed along to customers and clients, leading to cost-push inflation. It's over 2 years now since inflation began to rise above the Federal Reserve's targets. At first, many economists thought the elevated inflation would be short-lived, since it stemmed at least in part from COVID-related supply chain that would eventually be resolved. In fact, President Joe Biden was a leader at Team Transitory, insisting in 2021 that higher prices would be temporary. But from what we have seen, the inflation team is in a hasty retreat, given that the inflation went as high as 9% last year. So, to get inflation down, the Federal Reserve has raised interest rates at one of the fastest paces ever, boosting its short-term lending rate by 4.75 percentage points in a mere 12 months. Including the latest quarter-point raise on March 22nd. Even though inflation has dropped to 6%, Fed Chair Jerome Powell still maintains that it's not good enough. Also, a new analysis by 2 prominent economists contains some advice for Powell summed up in one short phrase: just give it time. Robin Brooks, chief economist at the Institute for International Finance, and Peter Orszag, COE of Financial Advisory at Lazard, argue that much of the recent spike in prices is due to COVID-triggered supply chain disruptions, and that normalization simply takes longer than many people expect. They also point to the considerable time lag in monetary tightening as justification for the Fed to take a wait-and-see approach by halting rate hikes and assessing the results of their work for several months, or even longer. Now, if Brooks and Orszag are right, the Fed would have more room to address the recent surge of regional bank failures, partly caused by rapidly rising rates. At least 4 major factors have conspired to push inflation up since 2021, but economists disagree on which of those forces is most important. Supply chain problems clearly caused shortages during the COVID pandemic, pushing prices up. Demand for goods soared as people stuck at home stopped traveling and going out and spent more on stuff. Also, tight energy supplies caused by Russia's invasion of Ukraine last year contributed to rising prices. Now that it has been established that inflation will last a long time, what should you expect? For one, labor costs will remain high until the economy hits a recession. This simply means that products relying heavily on labor will maintain high costs. A great example of this is the purchase of new homes. More expensive materials and a higher cost of labor result in newly built homes being more expensive. Also, the cost of buying existing homes and renting may also stay high. As labor workers earn more money, they have more money to spend, which contributes to high demand. That doesn't necessarily mean home prices will continue to rise, but they may also not fall back down in good time. By uncovering the truth behind transitory inflation, we have shown that transitory inflation is no truth. But we would love to hear from you in the comments. Do not forget to like this video. Bye for now.